You ever get that feeling? Like everything in business these days is just so global.
It really is.
Yeah, it's mind-boggling sometimes, right? And that's exactly what we're going to unpack today. We're diving deep into this whole global landscape. And joining us is expert Brad Poulos. We're going to be using a lot of his book, The Small Business Operator's Manual, as our main source.
Fantastic book. A lot of great information in there.
Really lays it all out there. So we're excited to kind of dig into that with you today. And I mean, you really can't escape how global things have become. I think the COVID-19 pandemic really drove that home for a lot of people.
You really can.
It was a major wake-up call, wasn't it? Suddenly, it wasn't just about what was happening in your own neighborhood. It became clear how interconnected everything was.
Yeah, remember when North American car manufacturers had to, halt production?
Oh, absolutely.
And it wasn't because they couldn't get tires or seats.
Right.
It was those little computer chips.
It's crazy, right?
Couldn't get them from overseas.
Yeah, it was a huge deal. And the source material really points out that this whole shift in manufacturing, it's not like a brand new thing. It's been happening gradually for decades.
Absolutely.
Like back in 1970, over a quarter, like 26% of North American workers were in manufacturing.
That's right.
But by 2019, that number had plummeted to just 8.5%.
Yeah, and there's a really fascinating reason behind that shift, and that is this kind of global demand for cheaper goods, which has totally changed how we do things.
Yeah.
We've become so reliant on other countries, not just for finished products, but for the raw materials and all the components in between, for just about everything. These global supply chains, I mean, they're incredibly complex.
And the source really emphasizes how important it is for every single link in that chain to work perfectly every time.
Absolutely.
So I think for some people, when we talk about these global connections, it can feel kind of daunting.
It is a big concept, right?
But the material actually frames it not just as a potential problem, but as a huge opportunity, especially for small businesses that are, agile and can adapt. Exactly. So that's really what this deep dive is all about, is how can you, as a small business owner, tap into these global markets?
That's the big question.
Now, obviously, there are some challenges. You've got different languages, different customs, different cultural norms. Not to mention, the regulations and laws can vary so much from country to country.
All of that.
So what our source really stresses is that it's crucial for businesses to educate themselves in all these areas. Before you even think about going international, you've got to do your homework.
Absolutely, yeah.
You can't assume things will work the same way everywhere.
You can't.
And just to kind of put things in perspective, our source points out, Canada, for example, their imports and exports of goods and services, each of those makes up about a third of the country's total trade. That's pretty huge.
That is significant.
And then for the U.S., it's about half that for imports. But their exports still count for about 10% of their entire economy. So it shows you how much international trade is a big part of the economic picture for both countries. And it's interesting, isn't it, how Canada tends to have this more balanced approach between what they import and what they export, whereas the U.S., they tend to import more.
Yeah, that is interesting.
And our source kind of digs into that a bit, and it highlights the key role of international trade for small businesses, in both countries.
A vital part, yeah.
All right, so let's dig a little deeper into these initial challenges you mentioned. Language, customs, culture. The material really emphasizes how crucial it is to grasp those nuances.
They are so important.
They really affect everything, from how you conduct meetings to the way you communicate overall.
Totally. And even those nonverbal cues you have to be aware of.
Exactly. It's almost like you need this whole new level of awareness.
You do.
Like our source gives this great example of a simple handshake, which in North America is like a standard greeting. But in some cultures, it could be totally inappropriate.
That's right. Could be offensive.
Yeah, and it's not just handshakes, right? Like the whole approach to business interactions can be so different.
Absolutely. In some cultures, you just get straight to the point, focus on the deal. But in other cultures, you really need to build that personal relationship first, and rushing that process could be seen as rude.
It's all about understanding the unwritten rules of engagement, really.
Definitely.
The source also mentions these concepts of power distance and uncertainty avoidance as key cultural dimensions.
Important ones.
Can you kind of unpack what those actually mean in a business context?
Sure. So power distance is all about how a society views differences in power and authority. In cultures with high power distance, you'll see a lot more emphasis on hierarchy, using the right titles, showing deference to senior figures. It matters a lot.
Okay, so understanding those hierarchies is essential. And uncertainty avoidance.
That's about how comfortable a society is with ambiguity and risk. So cultures with high uncertainty avoidance tend to prefer clear rules, detailed procedures, predictable outcomes. They don't like surprises.
So if you're doing business in that kind of culture, you need to be prepared, right?
Absolutely, yeah.
Detailed plans, clear agreements, all of that.
Definitely. And then you have the whole concept of time. The source gives this great example, actually, about punctuality for meetings in Mexico versus Germany.
Yeah, I found that really interesting.
Well, in Mexico, let's say you have a meeting scheduled for 8 p.m. Arriving around 8:14 area or even 8:30, that's considered perfectly acceptable.
Wow.
But in Germany, if you have an 8 p.m. meeting, you're expected to be there, maybe even a few minutes early,
Hmm?
7.55.
It's such a contrast.
It is, and it highlights how crucial it is to understand these subtle differences in how people view time. Being late in one culture might be no big deal, but in another culture, it could be a major sign of disrespect.
It really drives home that point.
Total.
You can't just assume your own cultural norms are universal. And, while English is often seen as the language of international business, the material really emphasizes the importance of learning at least a few basic phrases in your partner's language.
Oh, absolutely.
Even if they speak perfect English, making that effort, to greet them or thank them in their own language, it goes a long way.
It shows respect.
It does. It shows that you're genuinely interested in engaging with them on their terms. It can really build that rapport.
It's a small gesture that makes a big difference.
Exactly. And here's an interesting point. The source mentions how, in some cultures, getting a direct no can be really difficult. They might say yes when they actually mean no, or they might use more indirect ways of expressing disagreement. They give this great example of a Japanese partner saying, difficult question, when they really meant no.
Yeah, that's a classic example.
So how do you navigate that kind of situation?
Well, it's all about being aware of those cultural nuances. That reluctance to be direct, it often comes from a desire to avoid conflict or to maintain harmony. So paying attention to those nonverbal cues like body language, tone of voice, that becomes crucial.
Okay, so you have to read between the lines a little bit.
You do, and as the material emphasizes, building that long-term relationship is key. Right, because over time, you get to understand those subtle signals better.
Exactly, yeah.
So for you listening, the key takeaway here is you as a business owner, it's your responsibility to learn about the culture you're engaging with.
Absolutely.
Not doing so, it's not just a minor oversight. It could come across as disrespectful, and it could really cost you opportunities.
That's right.
All right, let's shift gears a bit. Let's talk about free trade agreements. The material highlights how there's this growing trend globally towards more open trade.
Definitely.
And that's led to a surge in these agreements, both between two countries and these multilateral agreements involving many countries.
Right.
And obviously, for businesses in North America, the USMCA, the United States-Mexico-Canada agreement, that's a major one. It replaced NAFTA back in 2020. So for businesses, what's the main purpose of the USMCA?
It's really about creating a more mutually beneficial trading environment for workers, for farmers, consumers, and businesses in all three countries. The idea is that if goods meet certain North American content requirements, they can move freely between the U.S., Mexico, and Canada without tariffs.
Right, so it's about removing those trade barriers.
It is.
The source mentions some key updates from NAFTA in the USMCA, things like a more open dairy market in Canada, some changes to intellectual property rules, and adjustments to those de minimis rules.
Right, those are the rules on how much you can import without paying duty.
Exactly, but the overall message seems to be that the impact on the day-to-day trade hasn't been that dramatic for most businesses.
Yeah, for many, things haven't changed all that much, so those existing strategies and relationships, they're still key.
Yeah, that continuity is important.
It is.
And it's interesting, Canada has all these other trade agreements with a bunch of other countries like the European Union, Israel, Chile, a whole bunch of others. It's quite a network they've got there.
It is. And each of those agreements is unique. They have specific details about which sectors are covered, what the exact terms of trade are, and trying to go through all those here would be, well, quite impractical.
It would be a lot.
The main thing is that they exist. These agreements can offer significant advantages if you're looking to trade with those specific regions. And the source directs people to the Canada.ca website as the best place to start your research. You can see if any of these agreements might benefit your business.
So it's really up to the individual business owner to take that initiative and explore those resources. Now let's talk about the different ways a business can actually get involved in the global marketplace. The material introduces this idea of a spectrum of internationalization, almost like a sliding scale.
Right, you don't have to go all in right away.
Yeah.
There's a range of options, allowing businesses to kind of dip their toes in, gain experience, and gradually increase their involvement.
So let's start at one end of that spectrum. We've got importing and exporting. The source describes that as the simplest and least expensive way to start engaging in international trade.
It is. It offers a lot of flexibility.
Right, you're not making huge investments.
Exactly. No big investments in infrastructure overseas. And it's easier to adjust if things don't go as planned. The trade-off, of course, can be lower profit margins sometimes because you're more reliant on those overseas partners.
Okay, so there's a balance there. And then we move along the spectrum to licensing. So how does licensing work as a way to go global?
So licensing basically means you're granting a company in a foreign market the rights to manufacture and sell your product. This usually includes your patents, trademarks, intellectual property, and in return, you receive a royalty based on their sales.
So it's a way to expand your reach without having to set up your own production facilities overseas.
Exactly, yeah.
Now, the material points out some important considerations here. Like if you're not familiar with licensing agreements or the legal requirements in that specific foreign country, it's highly recommended to get some legal advice.
Definitely from a lawyer who specializes in international licensing.
And, of course, protecting your intellectual property is paramount.
Absolutely needs to be properly registered in that foreign country before you sign anything.
Otherwise, you could be leaving yourself vulnerable.
Absolutely.
All right, next up, we've got joint ventures. This sounds like a more collaborative way to enter a foreign market.
It is. A joint venture is basically partnering with a company that's already established in that foreign country. You're sharing the responsibility of producing, marketing, and supporting your product in that market.
So you're spreading the risk, but you're also sharing the potential profits.
Exactly. It's a common way to enter those foreign markets because it reduces your individual risk and the amount of investment you need to make.
But the material really stresses how important it is to have clear agreements up front.
Absolutely clear agreements about who is responsible for what, how the costs will be divided, how the revenues will be shared, all of that.
It's all about laying that foundation.
It is.
And this reminds me of the story in the source material about your own experience with a joint venture in Latin America.
Oh, yes.
Can you tell us a bit about that?
Sure. So back in the late 90s, early 2000s, my brother and I had a company in the Canadian telecom industry. And we saw this opportunity to expand into Latin America.
Okay.
And we ended up connecting with a Canadian company that had a big presence in Mexico, a lot of experience there. They were selling computer parts, growing quickly.
Okay.
So we formed this joint venture, and it was a contractual agreement. We brought our technical expertise and relationships with Canadian customers, and they provided their distribution network, their local infrastructure.
Sound like a good fit.
It did. Initially, we agreed to split the profits 75-25 in their favor, based on what we thought the workload would be.
Okay.
But it didn't quite work out that way. No, we were at this trade show in Mexico, and it became clear that the amount of work on our side was way more than we had anticipated.
Ah, I see.
So I brought it up with my counterpart, and when I suggested a 50-50 split, he immediately agreed.
Wow, that's great.
It was. And it really highlighted for me how important it is to have good, trustworthy partners when you're doing business internationally.
Yeah, the source material really emphasizes that point.
It's more important than almost anything else.
And that joint venture, it didn't end there, right?
No, so as the business grew, we eventually turned that contractual joint venture into a separate company based in Mexico.
Okay.
And both our companies owned 50%. And a few years after that, we ended up selling our share of that Mexican company to its employees.
Oh, wow. So it went through all these different phases.
It did. It was a really interesting journey.
And it shows you how a business can evolve on that global stage. Now, at the other end of the spectrum, we have foreign direct investment, which sounds like the most significant commitment.
It is. This involves actually setting up a physical presence in that foreign country, usually by opening a branch plant or a subsidiary. You own it fully or partially.
So you're really putting down roots there.
You are. It's a major undertaking.
The source advises businesses to actively seek support from government agencies.
Absolutely. In your home country, there are often programs to encourage investment in certain regions. And then in the country where you're looking to invest, you might find support there as well.
Okay, so it's worth exploring those resources.
Definitely.
And this is something, it sounds like, that you should only consider after you've done a lot of research.
Absolutely. Thorough due diligence is essential.
You can't just jump in.
You can't.
All right, so we've looked at the different ways to engage globally. Now let's focus specifically on exporting. The material really emphasizes that if you're ignoring international markets, you could be missing out big time.
Yeah, especially for businesses that have a niche product or a unique offering.
Right, because the population of Canada and the US, they're relatively small compared to the global market. So limiting yourself to just your domestic market could really stifle growth.
Absolutely.
And the source even points out that you might be able to achieve higher profit margins in foreign markets.
That's right.
Maybe there's less competition, or maybe your product is seen as more valuable because it's scarce.
Definitely.
And beyond just higher sales, are there other benefits to exporting?
Oh, yeah, for sure. Exporting can boost your overall sales, which can lead to improved productivity.
Okay.
You can use your production capacity more effectively, often leading to lower per unit costs.
Okay.
And it can help extend the life cycle of your products by finding new markets for them.
Makes sense.
And you can even smooth out those seasonal ups and downs in demand if you're selling to markets with different buying patterns.
So it kind of stabilizes things.
It can, yeah.
All right, so you found your international customers, you've made the sale, but now comes a really crucial part: getting paid. This is highlighted as a major concern for exporters.
Absolutely. You need to have secure methods of payment in place, especially when you don't have that established trust or a history with the buyer.
So what are some safer ways to make sure exporters get paid? The first one mentioned is prepay and ship, or cash in advance.
That's definitely the least risky for the exporter. You get paid either before you ship the goods or at the same time as you ship them. It's often used for those initial transactions with new customers, and some exporters make it their standard policy.
Okay, so it's all about minimizing risk.
It is, but of course whether you can insist on prepayment depends on your negotiating power.
Right, it's a business deal.
It is.
Then there's the letter of credit. This sounds like a more formal, maybe more secure option.
It is. It's basically a guarantee of payment from a bank on behalf of the buyer.
Okay.
So as long as the exporter fulfills their end of the deal, the bank guarantees they'll get paid.
So you're relying on the bank's commitment.
That's right. The strength of that guarantee depends on the bank's financial health and reputation.
So you want to make sure it's a reputable bank.
Absolutely. Your own bank can usually help you assess that.
Good to know.
Another option is export trade credit insurance.
Right. How does that help exporters?
So both the U.S. and Canadian governments offer this insurance. It protects exporters against the risk of non-payment.
So it's like a safety net.
It is. The premium you pay depends on a few factors: the buyer's creditworthiness, the amount of the transaction, the destination country, and the type of goods. And it usually covers things like changes in regulations, even acts of war or civil unrest.
Wow, it's pretty comprehensive.
It is, but it usually covers a high percentage of the loss, like 85 to 90%, but not the entire amount.
So there's still a little bit of risk.
A small portion, yeah.
What about factoring or discounting receivables? How does that work?
So this involves selling your outstanding invoices, the money your international customers owe you, to a finance company at a discount. They take on the responsibility of collecting the payment, and they handle the payment terms. You get your cash right away, but it comes at a cost.
Okay, so it's about faster access to your funds.
It is. The cost is usually around 2% per month of the invoice value, plus other fees.
All right, then there's consignment. Now, this one sounds a bit risky for the exporter.
It can be. This is where you ship your goods to a foreign buyer, but they only pay you when they sell those goods to their customers. If the goods don't sell, they might be returned to you, or sometimes they're just disposed of.
So there's a lot of uncertainty.
There is.
The source says consignment only really makes sense if there's a really strong trust relationship with the buyer.
Yeah, usually built on a long history of doing business together.
And they also mention that using export trade credit insurance can help reduce some of that risk.
It can, yeah.
And finally, the material really advises against offering buyer credit or open account terms to international buyers, especially early on. Why is that?
Offering payment terms internationally is much riskier than domestically.
Okay.
It's because of the added complexities of international law, different legal systems. It can be difficult to pursue collections across borders if a buyer doesn't pay.
So unless you have a long-standing relationship or you have really strong export credit insurance, it's best to avoid it.
That's generally the advice, yeah.
Okay, so stick with those more secure payment methods, especially when you're just starting out.
Definitely.
Now let's talk about some support available for businesses going global. The source mentions trade missions.
Yeah, these can be incredibly effective ways to connect with potential customers and partners in those foreign markets. They're often organized by government agencies or industry associations.
Okay.
And then you've got embassies and consulates. A lot of them have dedicated staff who can help businesses from their home country sell their products in that local market.
So there's a lot of assistance out there.
There is.
And then there's the Canadian Commercial Corporation, the CCC. What's their role in supporting Canadian exporters?
The CCC focuses on helping Canadian exporters access foreign government procurement markets.
Okay.
So they act as a prime contractor when a foreign government wants to buy something from Canada.
Hmm.
They enter into a contract with a foreign government and then subcontract that work to Canadian businesses.
Okay.
And importantly, the CCC guarantees payment to the Canadian subcontractor, even if the foreign government hasn't paid them yet.
That's huge. It really reduces the risk for those exporters.
It does.
All right, let's move on to shipping and Incoterms. Now, these Incoterms, I know they can be a bit
It
confusing.
can be, yeah.
So what exactly are they?
Incoterms are basically a set of standardized trade terms. They define the responsibilities, costs, and risks involved in shipping goods internationally.
Okay, so they clarify who's responsible for what.
Exactly. They spell out things like who arranges and pays for transportation, insurance, customs clearance.
It's like a common language for international trade.
That's a good way to put it.
Now, it's important to note, the source points out, Incoterms don't cover things like the price of the goods, the currency of payment, or credit arrangements.
That's right. They're purely about the logistics of shipping.
Okay, that's good to know.
The source lists a few common Incoterms: EXW, FCA, FOB, and DDP. Can you break those down for us?
Sure.
Let's say you're selling handcrafted goods online. All right.
Okay.
So EXW, or X Works, that basically means your buyer is responsible for everything. From the moment the goods leave your workshop, they handle all the transportation, insurance, all of it.
Okay.
FCA, or free carrier, means you, as the seller, are responsible for getting the goods to a specific place, like a free forwarder's warehouse or the airport. Once they're there, the buyer takes over.
Okay.
FOB, or free on board, that's usually used for sea transport. It means you're responsible for loading the goods onto the ship, and from that point on, the buyer takes responsibility.
I see.
And finally, DDP, or delivered duty paid, means you're responsible for everything delivering the goods all the way to the buyer's location, including paying all those import duties and taxes.
So you handle the whole process.
You do, yeah.
And of course, the source recommends checking the ICC website for the complete list of Incoterms and the detailed explanations.
Always a good idea to stay up to date.
Absolutely. Now, there's this idea of title and risk of loss, which is closely related to shipping. When does that typically happen in an international sale?
So, while in domestic sales, ownership of the goods usually transfers to the buyer when they pay, internationally, it's not always that straightforward.
Okay.
The exact point at which the title transfers and who bears the risk if something happens to the goods is usually defined in the sales contract. And it's often linked to the Incoterm you've agreed upon.
Okay, so it's important to have that all spelled out.
It is, so both the buyer and the seller can get the appropriate insurance.
We've talked a lot about exporting, but the source also has some insights on importing. It suggests that importing can sometimes be less risky than exporting if it's done right. Why is that?
Well, in some ways, it can be seen as less risky because you're the one making the purchase.
Right.
But the source points out if you're dealing with a new supplier, they might want you to prepay for those initial orders.
Okay, so that initial trust building, it's still important.
It is, yeah.
The material mentions landed cost when you're importing goods. What exactly does that include?
Landed cost is the total cost to get those imported goods from your supplier's door to your own receiving dock.
Okay.
It's more than just the price the supplier charges you, the basic shipping cost.
Right. There are other costs involved.
There are like fees for customs forms, maybe fees for a customs broker, any import duties or tariffs, taxes, and other payment-related costs like fees for a letter of credit.
So you've got to factor all that in when you're pricing your goods for sale.
You do. Otherwise, you could end up losing money without realizing it.
And finally, the material mentions financing options for buyers of North American goods and similar programs from other countries to support their exports. Can you tell us a bit about those?
Yeah, so agencies like the U.S. Department of Commerce and Export Development Canada, they often have programs to help finance foreign buyers who are buying North American goods. And many other countries have similar programs to support their own exports. So it's worth looking into whether those programs exist if you're importing a significant amount of goods from a particular country.
Okay, so explore those resources.
Exactly.
This has been a really comprehensive deep dive into the world of global business. We've covered a lot of ground, from the big picture stuff to the really practical nuts and bolts.
We have, and I think the key takeaway, as Brad Poulos' book so clearly illustrates, is that business today is undeniably global.
It really is.
This presents both challenges and opportunities, but the businesses that thrive are those that understand this global landscape and approach it strategically.
So for you, our listener, here's a final thought. It's probably not a question of if your business will be impacted by global forces, but how.
That's the real question.
How can you use those forces to your advantage? What's one small step you can take, starting today, to explore international markets or potential global partnerships? Think about it. Thanks for joining us on the Deep Dive.
My pleasure.